Welcome to Market Radar, where we bring you a sharp overview of this week's key economic events. Come Monday, the spotlight turns to Japan's latest CPI figures. Despite a drop in energy costs positively impacting headline inflation rates, Japan's core inflation remains above the Bank of Japan's target, with the last month's data showing a rate of 2.5%, exceeding the 2% target. This paradox puts the Bank of Japan in a tight spot, as persistent inflation may compel a strategic pivot away from negative interest rates. While the country holds onto negative interest rates, the Bank of Japan seems to be cautiously eyeing the upcoming spring wage growth negotiations. A significant increase in wages is expected to trigger a rise in consumer spending and push inflation higher, the very scenario that could prompt the Bank of Japan to finally abandon its ultra-loose monetary policy. However, the Bank of Japan's decision hinges on more than just wages. Sluggish household spending and lower inflation readings in the months ahead could give the bank breathing room to delay its policy shift. The USD/JPY pair is poised for a quarter of dollar weakness as markets increasingly embrace the prospect of US rate cuts. This dottish tilt will leave the yen in a holding pattern, awaiting signs of domestic inflation before making any significant moves. Investors should monitor the yen and consider how Japan's commitment to moderate rising inflation could affect global markets and trade partnerships. On Tuesday, UK mortgage rates take the spotlight. Banks have been proactively cutting mortgage rates, betting on the Bank of England's easing in 2024. But if those cuts fuel consumer spending and inflation, the Bank of England might hold off on rate cuts, sending mortgage rates back up. Bank of England Governor Andrew Bailey's views on the UK economic health, inflation trajectory, and potential interest rate shifts are going to be closely watched. The focus will be on his views about the UK economic outlook, inflation, and interest rates. Any unexpected remarks or indications of future policy shifts could lead to significant volatility in the pound sterling. If the GBP/USD pair settles above the 1.2750 level, it is likely to head towards the resistance at 1.2820–1.2850. Watch out for the UK GDP, manufacturing, and trade data for November, set for release this Friday. Poor GDP or manufacturing figures might lead the BOE to reconsider rate cuts, potentially weakening the pound. On the other hand, strong data may support easing policies, thereby strengthening the currency. Tension shifts to the U.S. on Thursday for the highly anticipated Consumer Price Index report. With the S&P 500 hovering near record highs and investors yearning for certainty, Thursday's inflation report carries the weight of 1,000 cuts. A reading above the forecasted 3.2% could possibly slice through optimistic narratives like a hot knife through butter, forcing the Fed to reconsider its easing posture and sending markets into a tailspin. Several key Fed officials, including New York Fed President John Williams and Atlanta Fed head Raphael Bostic, will be speaking this week. Investors will be hanging on their every word for clues about the rate cut trajectory. According to the CME Fed Watch tool, the futures markets indicated approximately a 62% likelihood of a 25 basis points rate cut by the Fed in March, down from around 73% a week ago. On Friday, the Producer Price Index takes center stage. A surge in December PPI could indicate manufacturers passing on rising costs to consumers through higher prices, potentially reigniting inflation anxieties. To recap, from Tokyo's inflation tug-of-war to the Fed's rate cut tightrope walk, this week looks like another whirlwind of economic headwinds. That's it for this week on Market Radar. For more market analysis and technical insights, follow the Deriv blog. Thank you for joining us today.